The air crackled with a tension thicker than any trading floor on a Black Monday. For years, Barry Silbert had been hailed as a visionary, the architect of a sprawling digital empire. His creation, Digital Currency Group, stood as a colossus in the nascent, often chaotic world of cryptocurrency. From early investments in Bitcoin to the acquisition of key industry players, Silbert's foresight and aggressive strategy built an unparalleled conglomerate. But now, the very foundations of that empire are not merely shaking. They are under direct assault, collapsing under the weight of accusations that strike at the very heart of financial integrity. It is a charge that echoes through every corner of the financial world, from the hallowed halls of traditional banking to the decentralized ledgers of blockchain. Did Barry Silbert and his Digital Currency Group deliberately conceal staggering crypto losses? Was a complex web of financial maneuvers spun, not to innovate, but to obfuscate a deepening chasm of debt and insolvency? These are not mere whispers in the digital ether. They are the thunderous allegations at the center of a legal maelstrom, one that promises to reshape the landscape of digital finance and send shockwaves through the portfolios of countless investors. The narrative unfolding is less about technological revolution and more about the oldest story in finance, alleged deception. At its core lies Genesis Global Capital, a once dominant crypto lender, a jewel in the Digital Currency Group crowned out idol. But when the crypto winter of 2022 descended with brutal force, claiming giants like Three Arrows Capital in its icy grip, Genesis found itself exposed. The subsequent freeze on customer withdrawals was merely the first visible crack in what accusers claim was a carefully constructed facade. For the thousands of individuals and institutions who entrusted their digital assets to Genesis, this is about real money, trapped in a seemingly endless limbo. This is where the legal battles begin, a desperate fight for restitution and a quest for accountability from those who held the reins of power. At the core of this escalating crisis lies Genesis Global Capital, a once leading crypto lender under Digital Currency Group's expansive umbrella. The crypto market's tumultuous 2022 critically exposed Genesis, forcing a devastating halt to customer withdrawals that ignited a firestorm of legal actions. To stay ahead of such intricate and rapidly evolving financial narratives, remember to subscribe. The legal challenges against Barry Silbert and Digital Currency Group have intensified into a full-blown judicial war. Leading the charge is Gemini, the crypto exchange founded by Cameron and Tyler Winklevoss. For years, Gemini cultivated an image of regulatory compliance and trustworthiness, a stark contrast to some of the industry's wilder frontiers. This reputation led them to partner with Genesis on their Gemini Earn program, promising users attractive yields by lending crypto assets to institutional borrowers, primarily Genesis itself. This partnership, forged on mutual growth, became the crucible of the current crisis, transforming a symbiotic relationship into an adversarial one. The Winklevoss twins, once celebrated for early Bitcoin advocacy, now find themselves embroiled in a different fight, one waged fiercely on behalf of hundreds of thousands of their own users. Their motive is clear: to recover over $1 billion in user funds trapped within Genesis, funds lent through the Earn program and subsequently frozen. Their strategy is direct: accuse Digital Currency Group and Barry Silbert of systemic fraud and egregious misrepresentation, alleging a deliberate scheme to mislead investors about Genesis' true, deteriorating financial state. The genesis of this alleged betrayal traces to the market's seismic shifts in 2022. As the crypto ecosystem buckled under high-profile collapses like Terra Luna, and, critically, the catastrophic implosion of Three Arrows Capital, Genesis, a major lender to these entities, faced an existential liquidity crisis. Sources close to the situation describe frantic, high-stakes calls between Genesis, Digital Currency Group leadership, and Gemini's executives. Gemini pressed relentlessly for transparency, demanding forthright information and concrete assurances that user funds were safe. Accusations now allege that during these critical moments, Barry Silbert and his team provided misleading information and hollow assurances, painting a picture of Genesis's solvency dramatically detached from grim reality. The pivotal moment in this alleged deception involves the internal handling of Genesis' colossal losses from the Three Arrows Capital default. Instead of transparently declaring Genesis insolvent, a move that would have triggered widespread panic and likely bankruptcy, plaintiffs allege digital currency group orchestrated a complex maneuver. This scheme allegedly involved DCG assuming Genesis liability by issuing a colossal $1.1 billion promissory note. On paper, this financial sleight of hand made Genesis appear solvent, effectively transferring the gargantuan debt internally to DCG. But critics, including Gemini, vehemently argue this was a sophisticated shell game. They contend the note was never intended to be repaid in a conventional sense but served as a convenient accounting entry, allowing Genesis to record a receivable from its parent company, thereby artificially inflating its assets. It allegedly transformed an external, unrecoverable debt into an internal IOU, thereby masking Genesis' true, perilous financial condition from its external creditors and partners. This alleged deception created a dangerous information asymmetry. While Digital Currency Group and Barry Silbert allegedly possessed a clear, intimate understanding of Genesis' deteriorating finances, Gemini and its earn users were left in the dark, operating under the false premise of a healthy lending partner. Internal communications, now being scrutinized in court, are alleged to reveal a deliberate strategy to control the narrative, to downplay risks, and to avoid triggering widespread panic. The alleged motive behind this intricate financial engineering was to shield the broader Digital Currency Group empire from the direct fallout of Genesis' failures. Had Genesis declared bankruptcy immediately, the ripple effect across DCG's vast portfolio would have been devastating. By allegedly propping up Genesis with a deceptive accounting entry, Silbert and DCG were, it is claimed, attempting to buy time to weather the storm without triggering a full-scale public panic. When Genesis eventually froze customer withdrawals in November 2022, directly impacting Gemini earn users with devastating force, the sense of betrayal was explosive. Gemini, caught between its enraged users and its defaulting lending partner, was left to field the unbridled wrath of a betrayed community. Tyler Winklevoss himself took to public platforms, penning open letters that unequivocally accused Silbert and DCG of bad faith negotiations and outright fraud. He claimed that Silbert, despite allegedly knowing Genesis was teetering on the brink, had deliberately strung them along. The comprehensive lawsuits filed by Gemini are not merely seeking financial restitution. They are meticulously seeking to expose the intricate inner workings of this alleged concealment, aiming to prove DCG's intent to defraud, adding a formidable layer of intense pressure. The United States Securities and Exchange Commission has entered the fray, transforming a complex corporate dispute into a high-stakes federal battle. The SEC's intervention is not merely symbolic. It signifies a profound escalation, bringing the full weight of federal regulatory enforcement against Barry Silbert, Digital Currency Group, and Genesis. This shift from private lawsuits to federal scrutiny dramatically raises the stakes, introducing the prospect of monumental penalties, operational restrictions, and a fundamental redefinition of how digital asset businesses are permitted to function. The CC's primary focus centers on two critical allegations. First, that Genesis, through its earn program, offered unregistered securities to the public. Second, and intricately linked to the private lawsuits, the SEC's investigation delves deep into the accusations of fraud and misrepresentation. This directly targets the core allegation that Digital Currency Group and Genesis allegedly concealed massive crypto losses. If the earn program was an unregistered security, then any deliberate concealment of Genesis' precarious financial state, while continuing to solicit funds from the public, would constitute a severe fraudulent scheme. This moves the alleged actions beyond mere corporate mismanagement into the realm of potential securities fraud, a charge with far-reaching consequences. The ESX legal framework for identifying securities hinges on the Howey test, a four-pronged analysis derived from a 1946 Supreme Court case. It asks whether there is an investment of money in a common enterprise with an expectation of profit to be derived solely from the efforts of others. The SEC contends that Genesis earn, by soliciting crypto assets from investors who expected returns generated by Genesis lending activities, squarely met these criteria. Therefore, the program should have been registered with the SEC, subjecting it to stringent disclosure requirements designed to protect investors. The alleged failure to register, combined with the subsequent alleged concealment of losses, forms the bedrock of the CSX fraud claims. The enforcement tools at the SEC's disposal are formidable. In addition to civil monetary penalties that could run into the billions, the Commission can seek disgorgement of all ill-gotten gains. This means any funds Genesis or DCG allegedly earned while operating the unregistered security or engaging in fraudulent activity could be reclaimed by the government. Furthermore, the CC can pursue injunctions that would bar individuals, including Barry Silbert, from serving as officers or directors of public companies. Such a ban would effectively end Silbert's career in any regulated financial sector. A severe blow to a figure who has built his reputation within both traditional finance and the crypto ecosystem. The investigation also encompasses the complex intercompany dealings, with the SEC's power to compel testimony and demand extensive documentation, meaning that every internal communication, every balance sheet entry, and every executive decision related to Genesis' financial state will be subject to intense scrutiny. Digital Currency Group and Silbert are expected to mount a vigorous defense. Their arguments will likely challenge the SEC's interpretation of the Howey test, contending that Genesis Earn was not a security but rather a traditional lending arrangement outside the SEC's purview. They may also argue that they acted in good faith to stabilize Genesis during unprecedented market turmoil, and that the promissory note was a legitimate attempt to inject capital. However, the sheer volume of evidence being gathered by both private plaintiffs and the SEC will make this a challenging defense to maintain. This legal and regulatory showdown is not just about the fate of one company. It is a pivotal moment for the future of crypto regulation, poised to provide significant judicial guidance on how billions of dollars in digital assets are managed. The accusations of concealed losses against Barry Silbert and Digital Currency Group unleashed a torrent of fallout, sending seismic shockwaves through every layer of the financial world. It was a profound rupture of trust, igniting a whirlwind of reactions that painted a stark picture of the consequences of alleged financial misdeeds. This unfolding drama played out across countless screens and conversations, each a piece in a sprawling digital montage of dismay and outrage. For the thousands of individual investors caught in the Genesis freeze, the initial shock gave way to a potent blend of frustration and despair. Online forums, once buzzing with discussions of crypto yields, transformed into platforms for collective anguish. Stories poured in, retirement savings trapped, dreams of financial independence shattered, families facing unforeseen hardship. The sentiment was raw, fueled by a shared sense of betrayal. The public reaction was not just about financial loss. It was about the perceived violation of a promise, the erosion of faith in a system that claimed to be the future of finance. The ripple effect extended far beyond the immediate victims. Venture capitalists, once eager to pour capital into the burgeoning crypto space, became noticeably more cautious. Due diligence intensified with a renewed focus on corporate governance, liquidity management, and transparent financial reporting. The era of rapid, unchecked growth in crypto finance faced a harsh reality check. Startups seeking funding found themselves interrogated about their balance sheets, their lending partners, and their exposure to interconnected entities. The alleged actions of Digital Currency Group cast a long shadow, making every new venture in the lending or yield generation sector face heightened skepticism. Within the halls of power, particularly in Washington, D.C., the Genesis crisis provided fresh impetus for regulators already pushing for stricter oversight. Lawmakers and financial watchdogs pointed to the alleged concealment as clear evidence of the need for robust regulatory frameworks. The argument that crypto was somehow immune to traditional financial risks lost significant ground. Instead, the narrative shifted towards a consensus that greater investor protection was paramount, even if it meant imposing more stringent rules on innovation. This incident became a powerful lobbying tool for those advocating for a more centralized traditional approach to crypto regulation. The reputational damage to Barry Silbert himself was immediate and severe. Once lauded as a titan, a visionary who saw the potential of Bitcoin before many others, his public image began to fray under the weight of the allegations. His name, once synonymous with foresight and pioneering investment, now became inextricably linked with the accusations of concealing billions in losses. For a figure whose influence stemmed from credibility and a perception of astute leadership, this was a profound blow. The very trust he had cultivated over years was now actively being challenged, threatening to tarnish his legacy permanently. For the employees within Digital Currency Group's vast ecosystem, the atmosphere shifted from one of ambitious growth to acute uncertainty. The constant barrage of negative headlines, the mounting lawsuits, and the specter of federal scrutiny created a deeply unsettling environment. Talented individuals, many of whom had joined with a pioneering spirit, found themselves grappling with the erosion of their company's reputation and the profound stress of working for an entity embroiled in such a public and severe legal battle. This internal turmoil, though less visible than the public outcry, profoundly affected morale, recruitment, and the overall operational capacity of a once dominant conglomerate. The widespread fallout served as a stark, undeniable testament to the real-world consequences of alleged financial concealment in the digital age. As we navigate into 2025, the legal battles surrounding Barry Silbert and Digital Currency Group are poised to intensify, entering their most decisive chapters. What began as accusations of hidden crypto losses has now evolved into a fundamental test of trust and transparency for an entire industry. The complexities inherent in crypto finance, coupled with the sheer volume of claims and the formidable involvement of federal regulators, signal a protracted legal saga. The outcomes of these high-stakes lawsuits and the United States Securities and Exchange Commission's relentless investigation will set critical, universal precedents for accountability, investor protection, and the very regulatory future of digital finance. The core lesson is deeply tied to the imperative of transparency. The accusations against Digital Currency Group and Genesis center on an alleged deliberate obfuscation of financial realities, presenting a facade of solvency while allegedly harboring immense, unrecoverable losses. If these allegations are proven, it will serve as a stark reminder that even in the most innovative financial sectors, the foundational principles of honesty and disclosure remain paramount. The digital asset industry, often lauded for its decentralized ethos, has repeatedly faced challenges rooted in centralized entities failing to uphold these basic tenets. This case is designed to force a reckoning, to establish that a lack of traditional oversight does not equate to a license for alleged deception. The legal arguments are intricate, dissecting complex financial instruments like the $1.1 billion promissory note. The debate will rage over whether this was a legitimate, albeit desperate, attempt to stabilize a struggling subsidiary or a calculated accounting maneuver designed to mislead. Each piece of evidence, from internal communications to external audit reports, will be meticulously scrutinized, aiming to reveal the true intent behind the alleged concealment. The courts will be tasked with untangling a web of intercompany dealings, assessing the responsibilities of a parent company for its subsidiaries' actions, and ultimately determining whether a fraudulent scheme was indeed executed. For the countless individuals and institutions who entrusted their assets to Genesis, the pursuit of justice is a long and arduous path. Their frozen funds represent more than just numbers on a balance sheet. They are real savings, real assets, real life plans put on hold. The resolution of this saga will not only determine the fate of billions in trapped assets, but also offer a measure of closure, or continued despair, for those profoundly impacted. The emotional toll of this financial limbo is immense, making the legal outcomes deeply personal for many. This human element underscores the gravity of the universal lesson, that trust, once shattered, is agonizingly difficult to rebuild, and its erosion carries profound, far-reaching consequences beyond any balance sheet. This unfolding drama serves as a powerful reminder of the imperative for transparency and integrity in the rapidly evolving world of digital finance. The fate of Barry Silbert's empire will be a landmark case, signaling a new era of enforcement and investor protection, fundamentally reshaping how trust is earned and maintained in the digital asset market. The lessons learned here will resonate far beyond any single company, influencing the very structure of future crypto ventures. If you want to stay informed on these critical financial battles and understand their profound impact, consider subscribing. For another deep dive into a major crypto collapse, exposing an empire from the inside through startling courtroom confessions, open the on-screen card now for our video titled Caroline Ellison v. ETH Alameda. Courtroom Confessions in 2025, exposing Sam Bankman-Fried's empire from the inside.